Chapter 2, Analyzing Transactions. Okay, this is where we've been. We described the characteristics of an account and a chart of accounts, and we illustrated how to record transactions, journalizing them, okay, and using the double entry system. And I hope you did those journal entries, that journal entry exercise after it, because by the time you're finished, you should be in pretty good shape there. Now, what we're doing in this presentation is we're going to describe the journalizing and posting of accounts of transactions to accounts, okay, and then preparing an unadjusted trial balance and explaining how it can be used to discover errors. We are not doing this, so let's not do this part. Our errors are really hard, and frankly, you don't have to worry about that. So we won't do that piece, okay? Just these two. And I think we'll see how long it takes. I might do the last one also. Okay. So when we post the journal entries to accounts, let's say we've journalized an entry and we've got our two-sided transaction. Say we've got a debit to cash and a credit to fee revenue. Okay, now what we've got to do is update the account cash and update fee revenue to update the account so we know how much in total is in there. So here is our journal entry. All right, so here's an example. We've got NetSolutions paid a premium of $2,400 for an insurance policy. Okay, and it covers a 1-year period. So they're putting this in, it's still an asset, it hasn't been used up yet, so they're putting it in a prepaid insurance account, that's a balance sheet account, and crediting cash. So the asset cash decreases and the asset prepaid insurance increases. Okay, this is our journal entry, and there's the T account for the two accounts that are affected. Like in the journal, debits and credits for each journal entry are posted to the account in the order in which they occur. And the debit portion of the December 1st entry in the previous slide is posted to the prepaid insurance account by first of all entering the date, then the amount, the journal page, and the account numbers. So let's take a look at this. This would be a journal, and picture each one of these. This is our journal entry right here, and there's the account page in the ledger. All right, so if I took this prepaid insurance, it's $2,400. I updated the account by that entry, by $2,400. And what they're pointing out to you here by pointing out all the details is that this entry on December 1st, you can see it here in the account on December 1st. Okay, here's the cash account. There's the entry from December 1st. And we've got the $25,000 that was paid in on November 1st here, but now that's updated by a $2,400 withdrawal. Okay, and you can also see that the posting reference is in here. Now this prepaid insurance was posted to account number 15. So there's account number 15 for prepaid insurance. And cash was decreased. Cash was posted. Cash is account number 11. So account number 11 down here has their credit to cash. Okay, and both sides of the entry were posted, one to prepaid insurance and one to cash. And now these account balances are updated. Okay, and the reason why we're careful about putting in dates and posting references and things like that is so we can trace what happened. You'll be amazed at how messed up this can get. That's what keeps accountants employed. So now here's another transaction. They paid rent. On December 1st, they paid December's rent. The company is renting office space, now requires a payment on the 1st of each month rather than at the end of the month. So on December 1st, we're recording rent expense and crediting cash. And this is the current month, so we're just going to call it expense. Okay, don't worry about cutoffs and things like that. So that decreases cash, increases rent expense. Okay. Here are all the, oh, that's a purchase of land. I thought we were going to show the, this is another transaction, okay? They received an offer from a local retailer to rent the land that they purchased, and he's going to use the land for a parking lot, and he's going to get a whopping $360 for 3 months rent. And so this is one of those tricky accounts. That's why they want to go through it, and it's called unearned revenue. And what unearned revenue is, it's a liability for performance. Okay, we owe performance on this. We haven't done it yet. Okay, at the end of 3 months, we can recognize, or monthly, we could recognize $120 worth of rent for the parking lot, but right now we can't. So it's unearned revenue. Okay, in a tricky account. Here's our journal entry: debit cash, credit unearned rent, unearned rental revenue. Okay. Oh, no. Yeah, so that would still be a liability. Unearned rent or unearned, it would be the same thing. So we're increasing cash, and we're also increasing the liability. Now we purchase office equipment on account. So debit office equipment, credit accounts payable for $1,800. You can see that office equipment increases, and the liability, what we owe the accounts payable, increases. Next one, they paid $180 for a newspaper advertisement. So debit miscellaneous expense and credit cash. You know, whatever account you'd want to use here. If it was a sizable account, then you make up your own account for it. But, you know, I kind of tend to stay away from miscellaneous expense because you don't know what's in it. Obviously, huh? Okay. Another one, they paid creditors $400. Decrease the payable and credit cash. And if you're confused, do the cash first. Okay, they paid, so cash went out, you credited cash, you'd have to have a debit for $400. Okay, you're decreasing your liability. Paid a receptionist and a part-time assistant, $9.50 for 2 weeks' wages. Increase wage expense, credit cash. Debit wage expense, credit cash. Okay, and the accounting equation, we're decreasing assets, increasing expense, which decreases owner's equity. Then NetSolutions received $3,100 for fees earned for the first half of December. I've got debit cash, credit fees earned. Okay, increase cash, increase fees earned, which also increases revenue. So fees earned on account, we've got a lot of transactions here. And then we'll get down to the ledger on it. Yeah, we should be able to finish. Fees earned. When a business agrees that a customer can pay at a later date, then it's an accounts receivable. And that's a claim against the customer. Okay? So we earned a total of $1,750 for the first half of December. So now that we've earned it, we're going to recognize $1,750 and record the receivable, because it's, you know, we've done everything that we had to do to earn the fee, so the money is owed to us. It's how we spent our time, okay? Accounts receivable is in many ways just like cash. It's a step away from cash, hopefully. So increase the receivable, increase fees earned. And here's a journal entry that, I've got the answer here for you. Prepare a journal entry for fees earned on account, $115,000. So debit accounts receivable and credit fees earned. I think you guys should be through all this stuff by now. Here we paid creditors. NetSolutions paid $900 to Executive Supply on $1,800 that they owed them. We're paying, so credit cash, and your debit then would be to accounts payable. Network Solutions receives $650 from customers in payment of their accounts. So be careful on which way this money is going in or out. If it's coming in, it was a receivable. If we're paying, it was a payable. Okay, that can be confusing, so be careful with it. So cash is debited for $650, and then we reduce the receivable by $650. Now they paid for supplies. NetSolutions paid for supplies. And remember, if we just say supplies, it's an asset. Okay? If it says supplies expense, then the supplies are used up. But this is just an asset. So debit supplies and credit cash. December 27th, they paid the receptionist and the part-time assistant $1,200 for 2 weeks' wages. So debit wage expense and credit cash. All right. And even when you think about payroll, do you ever get paid in advance? You never do, right? You never get paid in advance. So we always get paid after the fact, after we've done the job. So that would be always an expense, okay? $12.31, NetSolutions paid its $310 telephone bill. So we're calling it utilities expense and credit cash. Okay, debit utilities expense, credit cash. Then they paid $225 electric bill for the month. All right, debit utilities expense, credit cash. And if you dump everything into utilities, then you don't know how much the electric is versus the telephone. So I would have a separate account for both of those. But you can see we're increasing the expense and crediting cash. Okay, we're getting there. Just a few more. Then they received $28.70 from fees earned for the second half of December. We're going to increase cash and increase revenue, fees earned. Okay, and we're taking revenue and expense, and they're in here inside of owner's equity, right? Revenue increases owner's equity, and expenses would decrease it. On 12/31, fees earned on account totaled $11.20. Okay, so we did the job that we was sitting in the receivable. No, it wasn't. We completed a job, but we haven't received the cash yet. So we're going to record an increase in account receivable and credit fees earned. And pay attention to this entry, because for some reason you'll be able to do all these hard entries, but when it comes to this, you won't remember what it is. Okay, so just make sure you can do this one. And finally, this Chris Clark withdrew $2,000 from the business. Now you know that cash is going down, so credit cash. And then you're going to increase the drawing account, and the drawing account increases with the debit by $2,000. Okay, decrease cash and increase drawing, but we're actually decreasing owner's equity because it's a negative account. And here's a journal entry to pay the payment of $12,000 for personal use. Okay. And this person, who was it? Dominique Walsh was the owner, so it was a debit the drawing account and credit cash. And one more, here is the beginning cash balance was $22,350. During March, cash receipts totaled $880. Okay, that's what we received. The ending balance was $19,125. So how much were the cash payments? This is a real nice little problem. Okay, a problem like this tells me if you understand the way a T account works, if you understand what the impact of cash receipts and cash payments would be on a T account. So make sure you can do this. And what I would do is I would actually total the two sides, and that what this has to be is the difference between $241,880 and $19,125. Okay, so our cash payments were $245,105. All right, but this is a nice problem. And here are some of our transactions. Here's the ledger just for cash. Okay, this is a real good example for all the entries that we just went through. Here's the entry for cash. And we've got some increases, and these are all decreases. Okay, and we also, these are the accounts receivable entries. Here are supplies, and you can tell there's a purchase. Here's where we used it. There's another purchase. Okay, here's prepaid insurance. It's still sitting in there. We've got $20,000 in land from way back in the beginning. Office equipment that we bought. Here are the transactions in accounts payable, and you can see you've got a lot going in and out here. The thing to remember is that this account has a credit balance, so this is an increase, there's a payment. Here's like a purchase on account, these are payments. Then we've got the one weird account, unearned rent. This is a liability for performance. We owe somebody $360 worth of some value, okay? There's the capital account, his initial contribution, and this is where Chris Clark withdrew money from the business. And here is a few more accounts. We've got fees earned. Now look at this. These are all of the revenue and expense accounts. And notice, like, revenue is increased by a credit, correct? So we only have credit entries in here. And all the expense accounts are increased by debits only. So your expenses don't go down, okay? The expenses only go up. So these all have debit balances. So the only accounts that really have debits and credits are the balance sheet accounts. Okay, the income statement accounts, revenue and expense, those revenue just has credits and expenses just have debits. Okay? All right, one more presentation here, and we're done, but make sure you do the problems so that you're clear on this and get a nice foundation for just this piece.